What is up, you guys? Peter Carlo here, Traders Helping Traders. Today, I'm currently in Texas. I pre-recorded this video, but I want to talk about selling puts. Selling puts is my favorite thing to do when it comes to trading. It truly is. On my main channel, Peter DeCarlo, I'll put the link down below. On my main channel, I talk a lot about selling puts. I talk a lot about investing, long-term investing, fundamentals. So if you want to learn more about that, go check out that channel. I'll also link below, and you can find on my main channel, if you just type in selling puts Peter DeCarlo, you'll see a video I made on selling puts. And on top of that, it actually shows you the options chain. So go and check that video out. I'm not going to talk about that right now. I'm going to talk about how it actually works behind it, because I found a really good article from Investopedia talking about it, and I just kind of want to go over, read the article together, and then I'll elaborate on the most important things and maybe some things you guys don't understand. So this is going to go on the ins and outs of it, and then if you want to actually look at the chain and figure out how to set it up and how to understand premiums, do that there as well. If you look at my main channel, you just type in Peter DeCarlo options. There's an entire options list and playlist. It'll also show you a beginner's video on options, which if you have no true understanding of how options work, I highly recommend that you check it out. So let's go into this. In the world of buying and selling stock options, choices are made in regards to which strategy is the best when considering a trade. Investors who are bullish can buy a call or sell a put, whereas if they're bearish, they can buy a put or sell a call. So one of the most important things that people don't realize when it comes to the world of options, there's a buyer and there's a seller. So if you're somebody who's buying a call, you believe the stock is going to go up, but that means someone's selling you that call. So if I'm selling you, the person who thinks it's going to go up, if I'm selling you that position, I believe it's going to go down, and vice versa. So let's say that I'm buying a put. If you're buying a put, like straight up, with most of you guys understand, if you're buying a put, you believe the stock is going to go down. But if somebody's selling me that, they believe the opposite. So bullish is buying a call or selling a put. Bearish is buying a put or selling a call. There are many reasons to choose each of these various strategies, but it's often said that the options are made to be sold. So this is true. 90% of people who make money trading options are the ones who sell them, myself included. It is very rare that I buy an option. It will explain it. 99.9% of the time, I'm selling options. This article will explain how to teach the difference. Okay, so let's just go over that. So there are multiple factors that can go into compromising an options contract value and whether the contract will be profitable by the time it expires. The current price of the underlying stock as it compares to the option strike will be as well, or will have to do with as well as the time remaining until expiration, play critical roles in determining an option's value. Now, if you were to go ahead and buy a stock position, I will actually bring this up real quick. I will actually bring up our options chain. I should be able to get Thinkorswim up very quickly here. All right, so this is the options chain for Activision. If this looks like some mumbo jumbo craziness, definitely watch that beginner options video I have on my main channel. But these options expire May 14th. You can see right here, this is the strike. So if I'm selling a put, I'm bullish on Activision. So that means that essentially when I'm selling a put, as long as the stock closes above the strike that I'm selling it at, I get to keep the premium. Now the premium, if you were to just buy a put normally on Activision, this is what you would have to pay, the premium. 68 is the ask, or the bid, and 72 is the ask. So what happens is the opposite happens for me. If I sell a put, I am bullish, and I am selling this option to somebody who thinks it's going to go down. I am selling this option to them for $68. That's what they pay. Now, a lot of people don't realize when you buy an option, that money that you pay for the option doesn't go into thin air. It goes to somebody who's selling you that option. So in this case, if I sold you this $92 put, I would instantly take your 68 bucks and put it in my bank account. And now, as long as Activision closes above $92 by this Friday, which there's a 65% chance that that will happen, I keep all of your money and you lose all of your money. Sounds pretty nice, right? How many times have you lost money on options? That means whoever's selling them to you is making bank. Now, let's say the worst case scenario happens, which we're going to talk about in this article, but let's say the worst case scenario happens and Activision crashes. There's some like bad news that comes out and Activision dumps 10%. Well, the worst case scenario is, as the seller, I just buy 100 shares of Activision at my strike price, which is 92 bucks. I just buy 100 shares of Activision at 92 bucks, which I don't really care because Activision's a great company. So that's where the premium comes in. The premium is the amount of money that the option is worth, and when I sell the option to a buyer, that's what they pay, is the premium, and I put that premium in my pocket. So I want to talk about that first so you guys get an understanding of what the premium is. So an option is made up of intrinsic and time value. Time is extremely important when it comes to options. If you guys don't already understand that, go back, like I said, watch the basics video. Intrinsic value is the difference between the strike price and the stock's price at the market value. The intrinsic value relies on the stock's movement and acts as almost a home equity. If an option is extremely profitable and is deeper in the money, meaning it has more intrinsic value, as the option moves out of the money, it has less intrinsic value. Option contracts that are out of the money tend to have lower premiums. So if we go back and we look at Thinkorswim, like I just said, and we're looking at these puts, right now Activision's worth $93. So these puts that are out of the money, like the $92 put that I just spoke of, that has little to no intrinsic value because it is very far from the price of the stock, which shows you right here, look at how little the premium is. Now, if I were to sell a $96 put, the premium's nearly 5 times that. So instead of $68 for the premium, I get $300 for the premium, but it has a lot more intrinsic value. And look at this, I only have a 16% chance of making money. I don't like those odds, guys. You guys, you know that. So that's where intrinsic value comes into play. Now, we also have a time value. This is where theta decay, a lot of people don't understand. Like, sometimes they'll buy an option and they'll be like, I don't get it, the stock's going the way I want it to, but I'm still losing a ton of money. That's because of time decay. So time value, an option with more time remaining until expiration will have a higher premium associated with it, as opposed to a stock that has less time and it's near its expirations. So let's take a look once again at our Thinkorswim. So look at this. This is May 14th. A $92 put for May 14th is worth 68 bucks. So if somebody buys this from me, I'll make 68 bucks. However, if I sell a put for June 18th for $92, right here, I'll make $276. So because it's an extra 6 weeks out in time, I will make like 5 times the amount of money. But my probability went down from a 68% chance of making money to a 51% chance of making money. So time and intrinsic value, essentially, the further out of time, the more money you'll make. The closer to strike price, the more money you make. However, the higher risk you have of losing money. Now, the further out in price, so the further away your strike is and the closer to the time of it expiring is, the less money you'll make, but you'll have a much higher chance. So one of your jobs to do as a portfolio manager and a trader is to find the discrepancies between the two, to find a option that you want to sell that has high enough premiums, which we'll talk about implied volatility pretty soon, but finding one that suits the amount of risk versus reward that you want to have. So in other words, the premium of an option is primarily comprised of intrinsic value and the time associated with the option, which is why the value is also called extrinsic value. So like I said, the more money, the higher the premium will be if the stock is further out in time and closer to the money, which means that's more money you'll make, but then again, more risk you'll bring on. Time decay. Over time, the option approaches to its expiration, the value decreases since there's less time for an option buyer to earn a profit. An investor would not pay a high premium for an option that's about to expire, since it would have little chance of the option actually being in the money. So, like I said, if a stock has less chance of if the option has a less chance of being profitable, it's going to be worth less money. And that's why there's a constant decay. The process of an option's premium declining in intrinsic value as the option expiry approaches is called time decay, or theta decay, for those of you who don't understand what theta is. So essentially, when you buy a normal option and you're constantly losing money to theta decay, that money's not going somewhere random. It's going to the person who sold it to you, which is why I love these, because the longer I hold, a position I sold, the more money I make quicker. It's decaying right into my bank account. So it's really nice. So higher premiums benefit the option seller. However, once the option seller has initiated the trade and has been paid by the premium, they typically want the option to expire worthless so they can pocket the full premium. So when you're selling an option, you want it to expire worthless on the person who bought it from you, because then you make all of the money. As a result, time decay, or the rate at which the option eventually becomes worthless, works to the advantage of the seller. Like we just spoke about, it works to the advantage of us. The seller looks to measure the rate of decline in time of value of an option due to the passage of time or time decay. This measure is called theta, where it's typically expressed as a negative number and is essentially the amount of money by which the option value decreases every day. Selling options is a positive theta, which means the position will earn more money as time accelerates. So you guys know, if you buy an option normally, how you don't lose that much money to time decay on the first couple of days. But if it's 3-4 days away from expiration, that's where you make your money. And so this is the opposite. If I sell a put, I'm not going to make a lot of money that day unless the stock really goes in my direction. I'm going to make more money the longer I hold it. So the longer I hold it, the closer it gets the expiration, the more and more I'll make. However, while time decay works in your favor for the option seller, not only will it decay as little as each business day, but it also works on weekends and holidays, which is why I freaking love this. Because what you don't realize, if you're buying an option, guys and girls, you're losing money on the weekends. You're losing money on Christmas. You're losing money on the holidays. When I sell you an option, I'm making money on the weekends. I'm making money on holidays because decay works in my favor. Remember, the option seller has already been paid the premium. So as soon as you sell the contract, instantly you get that money in your bank account. As a result, the option sellers are beneficiaries of a decline in an option contract. As the option premium declines, the seller of the option can close out the position, offsetting the trade and buying back the option. So what you can do is close the position earlier and actually buy back the option that you sold. I do that a lot. Normally when I'm up 70 to 80% is when I close out my position by buying back my contract at a lower price. And you get to keep the spread. Now, let's talk about implied volatility. Implied volatility, also known as your vega, moves up and down depending on the supply and demand for the option contract. An influx of option buying will inflate the contract to entice option sellers to take an option on each side of the trade. Vega is a part of the extrinsic value and can inflate or deflate the premium quickly. An option seller may be short on a contract and then experience a rise in demand for contracts, which in turn inflates the price of the premium and may cause a loss even if the stock hasn't moved. This is why I'm going to do a video on this for you guys, but this is why if you've ever heard of IV crush, let's say that you get like a call on Apple and Apple has earnings coming up and Apple goes up 5%, but the next day you're barely up on your option. Whereas if it was just a normal week and there was no, if there wasn't high implied volatility and there was no options, you would have made 400% return on your money. It's because as IV rises, i.e. that means that, as there is volatility that's implied to a move, the less money you're going to make. So at the same time, time decay will work in your favor of the seller, but it's important to remember the closer the strike price of the stock, the more sensitive the option will have to change in implied volatility. Therefore, the further out of the money, like we talked about earlier, or the deeper in the money the contract is, the less sensitive it will be to IV. So I usually sell pretty far out of the money puts because I don't want a high chance of losing. I'd rather take smaller profits, like 1% return a week, 2% return a week, than get stuck taking a loss. We'll talk about that. Probability of success. Now for me, I have it set up here on probability OTM on my Thinkorswim. And this is going to tell me my probability for success. So like if I were to sell on May 14th, which expires 3 days from now, if I were to sell a $91 put on Activision, I'd have a 75% chance of making money. It's freaking crazy. 75% chance of making 40 bucks. 40 bucks is not a lot of money. I'd have to tie up $9,000 to do that. But at the end of the day, not bad. I like those odds. So let's talk about probability of success for a moment here. If we take a look at your probabilities, option buyers use contract delta to determine how much the option contract will increase in the value of time. So you can use your delta, but really, if you're using even Robinhood, it will actually show you like what your probability is. I like to only sell puts on stocks that or on options that I feel have like a at least a 70% chance of making money. Now, I don't sell calls. I would not recommend selling calls unless they're covered, and I will save that for another video. Now, let's talk about worst case scenario, because this is like the biggest important thing for a ton of traders, because they're always wondering, this sounds too good to be true. How come everybody doesn't do that? We're going to go over that now. So, many investors refuse to sell options because they are fearing the worst case scenario. The likelihood of these events taking place are very small, but it's still important to know that they exist. So like I said, if you only play options where you have an 80% chance of making money, there's still a 20% chance that you're going to lose, and that's important to understand the downside risk. Selling a call option has a theoretical risk of the stock climbing to the moon. While this may be unlikely, there isn't any upside protection to stop the loss. So let's take a look, for instance, at let's look at NEO. This is going to be a good example for NEO. So let's say that we were going to sell a put on NEO today. And let's say right now, I'm going to sell a $33 put on NEO. There's 65% chance of me making money. And as long as NEO, which we'll look at my chart, as long as NEO closes above $33 by this Friday, I will make all of that money. But guess what? Let's say that NEO, some sort of news comes out and NEO pumps to $70 and NEO pumps 100% in a week. You know how much money I'm making? If NEO doubles in a week, you know how much money I'm making? 46 bucks. That's it. So that's a big downside, is that you cap the amount of money that you can make. So if you're bullish on NEO and you sell a put on NEO, but NEO goes up 100%, you're still only making 40 bucks. It's a big problem. Now, the second risk is that it's exercised, which means, like I said, we look at NEO. If NEO, I sold a put at 33 bucks. If NEO closes below $33 by even a penny, I get to keep all of my premium, which we spoke about earlier. But remember, I'm forced. It's not an option at this point. I'm forced to buy 100 shares of NEO at 33 bucks, which could be a problem. So at the end of the day, that is your biggest downside risk, is that number one, if the stock rips, you only make your premium no matter what. And if the stock dies, you're forced to buy these shares, which is not a big deal in my opinion. That's why I would say don't sell puts on crap companies. Don't sell puts on companies that you would not own for the rest of your life, because the worst case scenario, like for me right now, I actually sold, let me go back. I actually sold puts on Snapchat 2 weeks ago, and I sold a ton of $58 puts on Snapchat. And Snapchat closed last week at $54. So right now I own 400 shares of Snapchat, but I'm down about 12%, but I still own the shares. Instead of losing all my money, I still own the shares, which is amazing. So at the end of the day, to me, I can go ahead and sell covered calls, which I'll do a separate video on, or I can just hold the position that I have, or I can just close it out and take the loss if I really wanted to, but I'm not going to do that. So the bottom line, selling options may not have the same kind of excitement as buying an option. That's completely true, because if you bought an option, you could make 4, 5, 6, 7, 8, 9, 1,000% returns. And you're never going to get a home run, because remember, we're capping the gains. However, it's more akin to just hitting a single after single. However, remember that singles after singles will still get you around the bases, and the score is still count the same at the end of the day. And this is where I use a compound interest calculator by MoneyChimp. And I just want to show you the quick power of doing this. So let's just say you have $5,000 to sell puts with. And let's just say you're going to give yourself 30 years to grow. And every single year, you make 52% return a year, which means you make 1% return a week selling puts, which is very, very, I'm not going to say very, very easy, but for me, it's very, very easy because I've been doing this a long time. Normally, I can pull about 2 to 3% return a week. So that means that by the time that 30 years is up, we will have $1.426 billion hitting singles. Guys, that's the power of selling puts. I hope that this helps you. Let me know if you have any questions. I'm sure you will. It's not too complicated to wrap your head around and understand, but it is tough if you've never done it before. Thank you for all the support. Hit the like button, subscribe, and I'll see you when I get back from Texas. Peace.